Welcome, everybody. I am Lynn Gilman, the National President of CHW. I want to welcome everyone to another complimentary webinar from CHW. We are happy to see so many supporters, volunteers, and donors interested in this fascinating subject. We have a very knowledgeable and sought-after speaker with us for the next hour or so, and I know you join me in welcoming Lindsay Lubov. Lindsay is a philanthropic advisor at the Jewish Community Foundation of Montreal. Prior to joining the JCF, Lindsay worked at the accounting firm of Richter for over 8 years, specializing in taxation. Lindsay is a graduate of McGill University in the BCom and CPA program. She is also a member of the Quebec CPA Order and has completed the CPA Canada in-depth tax course. She speaks on this topic to foster generosity and to strengthen the Jewish community through effective planning. Also here with us today is Lindsay's colleague, Howard Barish, who is also a CPA from the JCF. Before I turn it over to Lindsay, I want to let everyone know that after Lindsay has finished her talk, we will have some time for questions. CHW's CEO, Lisa Cole-Kotler, will be moderating the Q&A, and so feel free to put your questions in the chat. Thank you. Lindsay, the floor is yours.
Thank you, Lynn. So today we're going to speak to you a little bit about smart philanthropy. Now, before we get into it, I'll just explain a little bit about what we do with the Jewish Community Foundation of Montreal. So our goal at the JCF is really to promote philanthropy. We encourage charitable giving by making it easy, efficient, and tax smart. What we do as philanthropic advisors, we meet with our donors and their families and help them meet their philanthropic goals in the most tax-efficient way that meet the donor's specific values and circumstances. That's really what smart philanthropy is all about. So today, we're here to discuss with you more about charitable gift planning and go over some of the most popular tax-efficient ways of giving. So now, charitable gift planning. One of the conversations that we have most frequently with our clients is about legacy giving. When we talk about legacy giving, we're normally thinking about after-lifetime gifts to charitable organizations that a donor cares about deeply. There's many ways that a donor could leave a legacy gift. They also don't need to be made after lifetime. They can be made now as well and put into a permanent endowment fund. Endowment funds are meaningful ways to create a legacy. I'm sure many of you are familiar with how endowment funds work, but when a donation is made, the capital is put into an endowment fund, it's invested and it grows, and an annual allocation is made to the charity to be spent on its needs. So the goal is that the fund continues to grow over time to support the charity in perpetuity without encroaching on the capital. Shortly, we'll go over some tax-effective ways of making these kinds of gifts. There's specific times in a donor's life when they are likely to think most about charitable gift planning. So some of those are estate planning, writing or revisiting a will, retirement planning, the sale of a business or another major asset, going through a divorce or a death of a family member, or after having received an inheritance. And when we talk about charitable gift planning, it's really not a one-size-fits-all. Everyone has different circumstances and goals. We'll usually talk to our donors about what to give, when to give, and how to give it. Now, in terms of the what to give, this is really how much as a donor do you want to give? So it could depend on your income level, whether there was a big transaction that happened in the year that gave rise to a large capital gain. Really, how much of a tax receipt do you want? Alternatively, when deciding on what to give, you can also think about, are there any projects that you want to fund, or really how much philanthropy do you want to do? Now, in terms of when to give, are you more interested in reducing taxes during your lifetime or at death? Did something happen in the year, like a transaction that triggered lots of tax, and we want to eliminate some of that tax now by getting a tax receipt in the year? Do we want to give an outright gift to the charity to fund something specific for their immediate needs, or set up an endowment that will be left to the organization in perpetuity? And then finally, how to give it. This is really what method is being used to make the charitable gift. So is it being done by a bequest in a will, life insurance, marketable securities? There's really several different ways to make these gifts, and we'll go over some of our popular gift plans shortly. Now we'll just briefly go over some general tax considerations before getting into the methods. So if we were to look at tax savings on a cash donation by a donor in the highest income tax bracket. So we're looking at right now the highest income tax bracket in Quebec. So a 53.31% tax rate. So on a donation of $1,000, a donor would realize tax savings of $533, yielding a cost of donation of $466. So to donate $1,000, it would cost a donor at the highest rate $466. Now, if that donor were to donate certain assets like marketable securities or mining flow-through shares, their tax savings on the donation can increase even more. It's important to note that donations may be applied against 75% of net income federally and 100% of net income for Quebec. And any unused donation receipts in a year may be carried forward 5 years. There's also some rules about taxation on death that I'd like to go over. So the general rule on death is that an individual has a deemed disposition of all their assets at fair market value. This could trigger capital gains and yield possibly significant tax consequences. There are exceptions like the principal residence exemption, life insurance proceeds, and anything left to a spouse or common law partner or to a spousal trust. So I just mentioned that donations can be applied against 75% of net income federally during lifetime, but in the year of death and the year prior to death, donations can be applied against 100% of net income. And on death, any donations can be carried forward to the estates. So these are just some tax rules that are something to consider when making a gift plan. So are you anticipating high taxes in the estate at death and want to have donation tax receipts at that time? Or do you need to eliminate taxes now or over the next few years and make a gift that would be most beneficial in the short term? These are all things that you would need to think about when doing charitable gift planning. So now we're going to be discussing the following popular gift plans that we see often. So charitable bequests, which is a gift from the will, gifts of appreciated marketable securities, gifts of life insurance, gifts of mining flow-through shares, and charitable remainder trusts. So now, charitable bequests are gifts made from a will at the time of passing. It's a simple and flexible way to leave a legacy gift. With a bequest, you're maintaining control and still using your assets during your lifetime, and then preserving the ability to make any modifications to your future gift. Gifts from a will can be made outright to the organization, or they can be set up as an endowment. You can structure a bequest to leave a specified dollar amount, a percentage, or the residue of the estate. This would all be specified in the will. As I just mentioned before, at the time of death, there's a deemed disposition of assets. So you're considered deemed to have sold all assets at fair market value. By leaving a gift in your will, your estate is getting a tax receipt that could go against any tax that has arisen on death. So you can reduce tax in the estate with any tax receipt from a bequest made in your will. Now, gifts of appreciated marketable securities. So when we're talking about gifts of appreciated marketable securities, these are shares that may be sitting in your portfolio, like Apple or Microsoft, that have gone up in value and are sitting with accrued capital gains. This is a really great way to make a donation, and you have the opportunity to save a lot of tax when dealing with appreciated marketable securities. So generally, when you gift a non-cash asset, you're considered to have disposed of the asset at fair market value and a capital gain may be realized. There is an exception that exists for gifts of publicly traded stocks, bonds, or mutual funds, where no capital gain is realized. So now, if you were to go and donate marketable securities, you're getting a donation tax receipt for the fair market value of the stock on the day of donation, but you're also avoiding any capital gains tax that you otherwise would have to pay had you gone and sold those shares. So you're getting the benefit from both ends. You're saving tax on not having any capital gains, and you're saving tax from the donation tax receipt valued at the fair market value of the shares on the day of donation. So really here you have the opportunity to substantially decrease the after-tax cost of charitable giving as compared to a cash gift. It's a great gift to do during your lifetime, but it's also great to do through the will at the time of death. We mentioned that all assets are deemed to have been disposed of at fair market value on death, triggering capital gains. So by donating marketable securities through your will, the estate is actually avoiding paying tax on those capital gains. When we're speaking to their donors who are redoing their wills and they're planning to make donations, we normally advise them to speak to their lawyers or notaries and put in a clause that says something along the lines of, to the extent possible, please make these donations by way of marketable securities. These types of gifts can be beneficial for individuals, but also for corporations. So if anyone has a holding company or another corporation that's sitting with appreciated marketable securities, there's an added benefit to doing donations through there. So for corporations, when you have a capital gain, a portion goes into the corporation's capital dividend account that can be paid out to the taxpayer as a tax-free capital dividend. Since none of the capital gain is taxable when we're dealing with donations of marketable securities, the full value of the capital gain goes into the corporation's capital dividend account to be paid out tax-free to the shareholder. Now we can go over from a high level, just some numbers to show the difference in tax savings between a marketable securities donation on the left-hand side versus tax savings from a straight cash donation on the right-hand side. So here we have an example. Let's say it's shares of any publicly traded company, Microsoft. You're sitting with appreciated marketable securities valued at $500,000 today that you originally purchased for $300,000. If you were to sell them today, you'd have a capital gain of $200,000. Tax on that capital gain would come to about $53,000. So because we're donating these shares, you're saving tax valued at $53,000 just from the capital gain. You're also getting a donation tax receipt valued at $500,000. The tax savings on that is $266,000. So your total tax savings between the capital gain and the donation tax receipt comes to $319,000. Now, had you donated $500,000 of cash, again, you'd have a donation tax receipt where you'd save $266,000. Now, if we compare the two options, the cost of the straight donation to donate $500,000 was $233,000, while the cost of donating marketable securities was $180,000. Both are valued at $500,000, but you have an additional tax savings of $53,000 due to the savings on that capital gain. So this is just one example, but it just goes to show that the increased tax savings that you could see by donating marketable securities. It really is a great way to do philanthropy at a lower cost. Now we'll look at gifts of life insurance. This is another popular way to do philanthropy and create a legacy gift. So life insurance proceeds is a great way to fund a charitable gift on death. We often see donors purchasing a new policy, initially naming the charity as owner and donate, and so the proceeds go to the charity on their death. Or we have some donors who transfer ownership of an existing policy for which, for whatever reason, they just don't need it or want anymore. So we'll look at an example where an individual takes out a new policy and names the charity as owner and beneficiary. So let's say an individual takes out a new $100,000 insurance policy. As part of the terms of the policy, $3,600 of annual premiums are owed over 10 years. Since the policy is in the name of the charity, the individual can pay these premiums by way of donation. So on a $3,600 annual premium, taking into account the donation receipt, the after-tax cost to the donor is $1,800 per year. So if we consider that over 10 years, the individual is paying $18,000 in order to create $100,000 of philanthropy through life insurance proceeds on death. Now that donor can consider endowing that gift, so they could even leave something in perpetuity to the charity that they care about most. So again, this is another great way to create a low-cost, significant philanthropic gift on death. Now, sometimes a donor will come to us with an insurance policy that for whatever reason, they no longer want to keep. Maybe they just don't want to continue paying the premiums, or they don't feel like it's needed based on their family circumstances. So what would happen is the charity becomes owner and beneficiary of the policy. Now, depending on different circumstances, either the charity would pay the premiums going forward and receive the proceeds on death of the individual, or the donor has the option to continue paying the annual premiums and receive a donation receipt equal to the value of the premiums on an annual basis. Now, since they're donating the policy, the donor would also receive a donation receipt equal to the fair market value of the policy at the time of donation. Just to keep in mind, the donation receipt that they would get now is not the face value of the policy. It would be the fair market value determined by actuarial valuation. So in the situations we just looked at, the donor is getting a donation tax receipt during their lifetime. This is beneficial to someone who wants to eliminate taxes now and may not have use for their policy anymore. Alternatively, a donor may feel it would be more beneficial tax-wise to save their taxes in their estate at the time of death and make the gift at that point. So what they could do is, instead of transferring the policy to the charity and making the charity owner and beneficiary, they keep the terms as it was before, have the proceeds of the insurance policy go into their estate at the time of their passing, then have the estate make the donation to charity using the life insurance proceeds. That way, the estate gets the tax receipt and can save taxes there. So now we'll move on to mining flow through shares. This is more of a complicated one, but it's really a great way for certain donors to create substantial philanthropy at a very low cost. So mining flow-through shares are shares of junior mining and oil and gas companies. And before getting into it, we'll take a bit of a step back. So if we think of a junior mining company and what goes into building a mine, it takes so many years of research, development, tons of expenses are incurred before actually building the mine and putting it into production and earning income. So these mining companies are entitled to certain write-offs and credits over the years due to their exploration and development expenses, but they just don't have taxable income to apply it against. So what happens here is an individual purchases mining flow-through shares, the money goes to the mining company, and then you get their expenses and credits transferred back to you to claim on your personal income tax return. The government put these types of deals in place as a smart way to stimulate these mining companies, but also promote philanthropy. So now if we get into the mechanics from a high level of exactly how it works. So an individual would purchase mining flow-through shares. It's not off the market. It would be from a certified dealer, like you may have heard of Pear Tree or WCPD. So an individual purchases the shares from them. A portion is immediately sold, and a portion of the shares are donated to charity. So from the portion that's sold, the individual is realizing a capital gain. But you're also getting the write-offs from the development and exploration expenses. You're getting investment tax credits transferred back to you, and you're getting a donation receipt because, like I mentioned, a portion of the shares was donated to charity. So after taking into account these write-offs, the investment tax credit, the donation receipts, you have the possibility of making a philanthropic gift at a cost as low as 2%. So let's say you're making a donation by buying and donating these mining flow-through shares of $100,000. It could cost you down to $2,000 to make that gift. Now, you do need a high income on your tax return to be able to do this, because you need to be able to take advantage of all the credits and write-offs that are being transferred to you. And you need to pay attention to alternative minimum tax, which is a parallel tax calculation that's run alongside your personal income tax return. So we normally recommend our donors who are interested in doing gifts of mining flow-through shares that they speak to their accountant, they run all the numbers, and they make sure that they really are taking advantage of all these credits, deductions, and that they aren't being impacted by alternative minimum tax. Finally, I'm going to discuss charitable remainder trusts. So a charitable remainder trust is established during a donor's lifetime. How it works is a donor makes a gift, and that the funds from that gift are put into a charitable remainder trust. The capital is held in the trust and invested over the long term, and the donor benefits by having the income transferred back to them for as long as they're living. So the donor receives an immediate tax receipt equal to the residual value of the gift. It's also an actuarial calculation taking into account life expectancy. And the donor continues to receive income from the trust for his or her lifetime. That income is taxable in the donor's hands. Then on death, the charity receives the capital in full. So if we look at just an example of how this would work, say you and your spouse are 70 years old and you want to make a donation of $1 million. So based on the actuarial calculation, you would get a receipt of, say, $700,000, which can be used to offset your taxes now or over the next 5 years. But the receipt is an immediate benefit to you. Then you also benefit long-term as well, because you're getting the return that's earned on the $1 million. So if the trust is earning 4% on the $1 million, you're getting $40,000 per year in income, which is taxable in your hands. So this type of structure works well for people who are older and don't have children to leave assets to in their will, who would otherwise have left most of their estate to charity, and who don't expect large taxable income at death, because instead of making the donation at that time and using the tax receipt in the estate, they're using it now or over the next 5 years. Now, there are other more complicated ways of making substantial gifts. One that I wanted to quickly mention is gifts of private company shares. This is something that's beneficial when a donor has realized a substantial capital gain in the year, either from the sale of a business or sale of real estate. So without getting into it now, because it's complicated, if anyone has gone through a transaction or is expecting a substantial capital gain and wants to learn more about gifts of private company shares, please feel free to reach out to myself or Howard, and we can guide you on that. And the same thing goes for any of the mechanisms that we just mentioned. If you have any questions or want to know more about how it would apply to your circumstances specifically, we're more than happy to discuss that with you, and you can reach out to us at any time.
Great. Thank you so much, Lindsay, for your presentation. It was very informative, and I really appreciate you taking the time to join us today. Just a couple of things I wanted to point out to our viewers, and that is, as you know, Lindsay and Howard are both from Montreal at JCF, so certainly they can answer your questions. But some of what they're talking about is specific to Quebec, and may not apply to viewers from across the country. Probably the best place to start if you have questions is to direct them to me, and then I can find the right person for you to speak to about how to make your legacy gift, and connect you with the proper expert. So I just wanted to share that. And also, you know, the first slide that Lindsay shared about JCF, you know, and talking about endowments and so on. CHW has an endowment fund. We have many donors who have allocated and restricted gifts to our endowment, and we follow the donors' instructions in terms of using the interest earned on the capital to allocate to specific projects or programs that donors want to fund, whether it was a gift made during their lifetime, so that the interest will fund in perpetuity any particular programs or projects, or gifts made through an estate gift. So I just wanted to point that out as well, that CHW has its own endowment fund. So I want to encourage all of our viewers to put your questions in the chat. There is a question from one of our viewers to ask about donations of art, and I guess that would also extend to any property or any type of material item. And I don't know if either of you want to address that.
Do you want to address that?
Well, generally, general art that's donated is considered, the general rule applies to it that you would be considered to have donated the property, the art, at its fair market value, and you would get a receipt for the fair market value. But at the same time, you would be considered to have sold it. Lindsay used the expression deemed disposition. You would have been considered to have sold it. So if you have a gain, if that fair market value is higher than what you paid for it, you would also have to have a gain that would have to be recognized. Now, there are certain exceptions to that for something called Canadian cultural property. It's a little more complicated. You have to get the artwork certified as being Canadian cultural property, and in that case, you would not have the capital gain that would apply as, on general donations.
I wondered if you can comment on the need for any appraisals.
Anytime you donate anything other than cash, we would need an appraisal from a qualified person who's appraisal, whether it be real estate from a real estate appraiser, whether it's shares of a company where we would get someone's called a certified business valuator, who would give us an opinion as to what the value of the shares are. And for art, I mean, I'm not that familiar with the art world, but I'm sure there are qualified appraisers in the art world who could give us an independent valuation for that property.
Okay. Occasionally I've had people call me and ask if they can donate a car to us. Any comments on donations of cars?
Well, you can, I mean, the simple answer is you can donate cars. For us, we would not want a car donated. You may not want a car donated because then you have to worry about, selling it and all that. I know there is one charity, you've probably all heard commercials about cars for kids.
Cars for kids,
So
yeah.
I guess they're they're familiar with it and do it all the time. But once again, a car is like anything else. You'd be considered to have donated at fair market value. If there was a gain, you'd have to recognize a gain. And then once again, it depends in any given charity if they want that, because then they have the whole hassle of disposing of the car.
Okay. I apologize if you hear my dog in the background. I'm working from home. My apologies. What would you say, when a donor is structuring a legacy gift or, doing their estate planning, what are some pitfalls or words of wisdom or, things that have transpired? I've seen things over the course of my career, of course, that are challenging to charities when they're receiving an estate gift that had the donor realized in advance when they were structuring their gift, maybe they wouldn't have done. Any thoughts or enlightening things you can tell our viewers about how to structure it, what to write into a will, things to be careful of?
Well, the main things I'd say is, and I think Lindsay mentioned in her presentation, if you're leaving something in a will, you would want to specifically put in the will that you can make donations to the maximum extent possible out of appreciated marketable securities. Generally, when you say they're like, what are the trips or traps? I mean, I think if you're dealing with any sort of substantial estate, you do need a tax advisor to make sure that it's worded properly. And that many cases you may want to leave, so a lot of people leave their estates to their spouse, either outright or in a spousal trust. And then they want to make donations when the second spouse passes away. So there's very careful wording on how you do that, because you have to sort of word it that you give the executors of that spousal trust the right, not necessarily the obligation, to make that donation, because there's a technicality that if the initial person who passed away says you have to make that donation from the spousal trust, the Canada Revenue Agency doesn't consider it really a donation. There's all sorts of technical rules for that. So, I mean, I think you have to be aware of things of that nature.
So when you're talking spousal trust, just to clarify, that has nothing to do with the residual in, say, someone's RIF or RRSP. That's separate. I'm confused on the
Yes.
term spousal trust. I'm not familiar with that.
Well, the spousal trust generally is the first spouse dies, and he or she leaves, in a simple case, straightforward, his entire estate to the spousal trust, which means that as long as the surviving spouse is alive, that person is entitled to all of the income of that spousal trust, and nobody else can get any of the income, and no one else can encroach on the capital until the second spouse dies. So, and if that's the case, it means the deemed disposition, which Lindsay described, does not apply. I mean, you have a deemed disposition, but it's at a cost base, so there's no gain recognized on the first death, the gain will be recognized on the second death in the spousal trust. Now, things like RIFs and RSPs, once again, if you leave it to a spouse or in a spousal trust, so there is no tax at that point. It goes tax-free to the spouse or spousal trust. If you don't leave it to the spouse or spousal trust, then the fair market value of the RIF or the RSP is included in the income of the deceased. Now, so what some people do, we may suggest is, depending on the needs of the beneficiaries and how big the estate is, if they donate the RSP, so the donation receipt will offset the income from the RSP. So example, if you had $500,000 in an RSP, and you're not doing a spousal trust, so you'd have $500,000 of income from the RSP. But if you donated it, you'd have a $500,000 donation, so they would offset each other.
So just to sort of understand a little better, so if I have a $500,000 residual amount in my RIF, so my spouse has died, this is the residual when I die. Is my family better off donating that residual amount to offset taxes or take the money themselves?
Well, no, there has to be charitable intent. I mean, if you have a $500,000 RSP and you don't donate it, so you're going to pay, let's say, $250,000 in tax,
Right.
you'd be left with $250,000. But if you donate it, you're going to be left with zero. So you have to have wanted to make a donation, and it's a good vehicle to use the donation to offset the tax on that RSP. But in terms of, would you end up ahead of the game? You don't end up ahead of the game. You just end up giving charity and getting a good tax break on it. Right.
But I guess what I'm trying to get at, but I'm not wording it well, is if you donated if as the recipients of an estate, you donated the residual of the RIF or the RSP, and you get the tax break, you can use that against any other taxes that has to be paid in the estate, right? Like the probate tax, and you can offset it, isn't it?
Probate tax is something else, but we don't have that in Quebec. But
or income taxes, I guess.
Separate from income tax.
Okay.
No, you would use the receipt. Yeah, I mean, in terms of in your tax return, you would show the $500,000 with all your other income. And then you would get a tax credit for the $500,000 donation. So it's not as if, it's not mechanically, it's not like you're attaching the donation to the RSP. But the effect is that you're sheltering the tax on the RSP.
Okay. Because as I understood it, it was a good vehicle to make a charitable gift this way, was to use the residual of a RIF, because your family's only gonna get 50% of whatever's left. And there's only two recipients here. There's your family and the government. So if you donate even if you donated 50%, you're still better off than not giving a charitable gift this way, because you're getting better tax advantages. I'm probably not explaining it well, but that's what I had always been.
Let's be clear, okay? When you make a donation of this sort, okay, you're giving up money.
Right.
You're getting a tax break, but you're not coming out even. The donation receipt is only worth half of the amount you've given.
Right.
So once again, if you get 500,000 and you only donate 250, the 250 is only saving you 125 in tax.
Okay. Thanks for clarifying that. One other clarification question: what's the advantage or disadvantage of a spousal trust versus a charitable remainder trust? Can you just clarify that for one of our viewers?
Yeah, they're just completely different things.
Okay,
A spousal trust would be, and you can do one during your lifetime too, is just a matter of transferring assets to your spouse. Okay, or to the spousal trust. So a trust in which everything goes to the spouse, they get all the income and they can encroach on capital. And normally it says you can encroach on capital for an emergency and the spouse would have, or for whatever reason, according to the terms of the spousal trust, but no one else can touch that. But a charitable remainder trust is you're really giving the residual value to charity. It has nothing to do with the spouse. I mean, you could make it work so that it happens on the death of the second spouse, but basically a charitable remainder trust is just ensuring that while you and or your spouse are still alive, you'll get the income from the capital. But on death of the second one, if it's set up that way, it could be on only one or on both. On death, that whatever's left in the trust goes to charity. But you get the receipt in the year you set it up, not in the year of death.
okay. In the case of a spousal trust, are there administration fees and so on to have a spousal trust set up? And is the spouse the trustee?
No, the spouse can be one of the trustees. In terms of administration fees, when you say generally, when you have a spousal trust, you're still going to need an accountant to keep track of what happened to the account and file, tax returns for that spousal trust because it's considered a separate taxpayer. In terms of fees, it sort of depends. Normally, if you've got a spousal trust and you have 3 executors who are sort of close friends or family members, it depends if they're going to charge you something or not. If one of your trustees is a professional, they will charge you a fee for their services. If you go to something like a bank or a trust company to administer the spousal trust, then they have fees for doing that.
Okay. Wondering if anybody else has any questions before we thank our guest speakers. Is there anything that you may have forgotten to share with us that you think would be a benefit to our viewers? I can't think of any other questions.
Well,
When
I say not
think more
really,
than
there's
anything,
lots of.
in terms of a takeaway, I would certainly want everyone to know that it's very important to have a will.
Absolutely, yeah.
Everyone should have a will in Canada, and it's CHW has been a part of your life for many years, I'm assuming, and as an organization, we rely on the state gifts. They help to help us to grow in our endowment, help us to meet our commitments each year. We have many donors who set up restricted endowments with us. And there's, advantages to doing that, or certainly as you both shared, different tax vehicles that can, different vehicles of donation that can help with tax advantages depending on your current situation, whether it's the donation of securities or flow through shares, as you mentioned, or setting aside a certain amount in your insurance policy, which can be done without opening your will, by the way, because I do know a lot of donors who maybe don't want to spend the money to go back to a lawyer and open up their will. Having even a small insurance policy with CHW as the beneficiary is advantageous as well. And for those of our viewers, for example, who are at the sustainer level of giving and making an annual gift with a minimum of $1,000 in perpetuity, once you've passed, so does your donation. So having a will, having a set amount in your will or an insurance policy with the restrictions that those funds be endowed and the interest earned each year be used for the charity to meet its commitments ensures that your sustainer level giving is in perpetuity. So it's something to consider. I want to thank you both so much for joining us today, and thank you for your wonderful presentation. And I just want to wish everyone a Shana Tova, a sweet and healthy New Year. And I think we're all praying for peace in Israel and the safe return of the hostages. So thank you very much. And Lynn, thank you as well. And we look forward to seeing all of our supporters in the coming months at events and webinars and so on across the country. So thank you. And
Thank
Shana
you.
Tova.
Thank you.
Thank you.
Thanks,
Thank you for the
everybody.
opportunity to talk to you.
Bye-bye for now.
Bye.